Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about the an article that came out on Realtor.com. It's about mortgage rates and affordability, and it's a very cool chart in here. But what we're going to talk about this myth that if mortgage rates go up, home prices have to just fall dramatically. We did a video similar, but we have charts in here. We're going to talk about some specifics in this chart because people see these charts and then they make assumptions, but there's premises that they aren't aware of. Okay, so the article said mortgage rates just jumped again. Check out how much more homeowners have to shell out each month. Okay, first of all, I have a problem with the headline.
Yes.
It says check out how much more homeowners. This is so what this means when I read this is, oh, my friend bought a house a couple years ago. Wow, he probably has to shell out a ton of money more each month on his house because mortgage rates are up, so his mortgage is more. What's the fallacy with that?
So that doesn't happen, right? Because most of us have fixed rate mortgages. Almost all mortgages across the U.S. are fixed rate mortgages, so that doesn't happen. Now, regarding the people getting new mortgages, that's a different story. However, even that is misleading, right?
Yeah, super misleading.
Super misleading because, of course, it all depends on how much down payment you put down. So if you're putting 20, 30% down, are you paying more in interest? Yes, of course you are. But is it commensurate with what the article is implying? Probably not.
Okay. I'm gonna put the chart up here. This chart's pretty cool. So this is a chart. It goes back a couple years. The red line is monthly payment based on getting a mortgage. Okay, it would be your monthly payment, and that's the monthly payment of when you originated the loan. Okay, that's originating the loan. And if you look back there in 2000, it was really low for a while, like $1,500 a month. A little over $1,500 a month. And then as you can see, as interest rates have gone up, it's gone up to that top line, which is about $3,000. It peaked at $3,154. And that was when interest rates went to the highest, that they're like 7.6 or whatever, right? And then it started declining again. Actually, from mid-October to early February, it actually improved by $500 a month. Homes got more affordable by $500.
So where are the headlines saying homes are more affordable by $500?
And I want to, and the other thing too is, well, home prices should have shot up, right? Because if mortgage rates going up tanks home prices, and it certainly does choke off demand. We're not saying that. And then you can see it's going up because this is actually the little dot is like yesterday. It's real time data, so it's just showing affordability or unaffordability in this case going up. Okay, but there's two big problems with this chart. Okay. We're going to talk about it in a second, but the first thing I want to talk about is, let's say you bought a house in mid-October 2022. You're paying $3,154 a month in your mortgage, right? A couple years from now, let's say mortgage rates go back to 4%, and you've got a 6.5% interest rate. What can you do to alleviate that?
So you're going to refinance, and when you refinance, provide that you don't pull money out, your monthly payment will go down substantially based on two things. One, based on the interest rate, of course, and two, it'll also go down based on the loan to value. Because remember, now you're re-amortizing over 30 years and you have more equity in the property because you're not going to be financing the same amount you financed before since you've been paying down a part of the principal.
The other problem I have with this chart is this is using the highest measurable rate when they quote interest rates, which is the 30-year fixed, and it doesn't include other things. So, for example, Juana, if you get a 15-year fixed, do you get a better interest rate?
Sometimes, so this is a really interesting point.
Yeah.
So when we've talked about this before, so you have to kind of look, because depending on what the market believes the interest rates will be doing, most of the time, the 30-year interest rate is higher than the 15-year interest rate, but
like 95%.
Right, yeah. But there are times when they are inverted, so you do have to really pay attention and see what's happening.
Interest rates have to be extremely low for that to happen. It happened in 2020 for a short time. No one was getting 15% rates. They were just getting the 30 because the 30 was cheaper. Okay. Here's the other thing. If you get a VA loan, substantially less than this. If you get a jumbo loan, substantially less. Jumbo loans are substantially less than the prevailing 30-year rate. Here's another thing. You have a wealth management relationship with a large lender, JP Morgan Chase, somebody like that. So they manage your assets. Maybe they manage your 401k, or you inherited some stuff, or you just have some wealth, they manage that. They offer substantial discounts to whatever the prevailing interest rate is.
Right. Not only that, but you can also, most of the time, if you bank with that institution and you pay your mortgage via automatic draw, a lot of times they'll knock off anywhere between an eighth to a quarter point interest on your loan.
Okay, here's sort of the last thing. This was calculated on average with only putting 14% down.
So 14% is an interesting number because hardly anybody puts 14% down, right? Most people put down 10%,
they were
20%.
They were trying to interpolate between the 20% people and the FHA VA people.
Right.
So they just came up with 16%. But there's a problem, 14%.
Yeah.
It was 14%. It was 14. But here's the problem with that. What about all the people who pay cash? How much is their mortgage payment?
0.
Yeah, they don't have a mortgage payment, right? So what about the people who put 50% down?
Well, they're obviously in better shape. What about the people who assumed a sub 3% loan?
Yeah, it's happening.
They're doing pretty well.
Okay, here's the other thing, Juana. Let's talk about this. The conventional wisdom is, oh, well, if everybody is having to pay this much, they won't do it. Because it's a fight. It's the seller, because the seller doesn't have to sell. I hate this term, forced to sell. People say, Todd, they're going to be forced to sell. We were hearing last spring about all the people that are going to be forced to sell. Forced to sell. And the inventory is the lowest it's ever been. If all these people are being forced to sell, why aren't these houses on the market?
Well, very few people are forced to sell. Circumstances force people to sell, not interest rates.
Okay. The other thing is, isn't it true that in a negotiation, if you have something that I want, then you probably have an upper hand in the negotiation because I want what you have. So you want terms that are appealable to you. And if you don't get the terms, you'll just, because you have the one thing and multiple people trying to get it. So if I come to you and go, hey, I really like your house. 2 years ago, I could have bought it for $1,500 a month. The only way I can get it today for $1,500 a month is you have to drop your price 30%. So I demand that you drop your price 30% so I can go get a 6% loan and buy your house and only pay $1,500 a month. What do you think?
It's been real. It's been fun, just not real fun.
Okay. So you have choices. You don't have to. So you're not forced to sell.
No.
And you'd rather wait for a cash buyer or somebody just willing to pay a little more for the house and then deal with a refi later.
Right. And remember, I mean, buyers understand that inventory is limited, and buyers are starting to come to grips with the fact that there are more of them chasing houses than there are houses on the market. And even in the luxury market, we are seeing multiple offers. So, the idea that we're not going to see multiple offers in the rest of the market doesn't make any sense. If in the luxury market we're seeing that, then the rest of the market is going to see that, double and triple that, of course, because you have a lot more people that are in the market for something in that price point.
In a normal market, we have about 2 million houses on the market. We have a third of that right now in the U.S. So isn't it reasonable that a bunch of buyers are going to be excluded from the market, especially these people, the people that would pay this $3,000 a month? They're basically, the market doesn't really need them.
Right.
We need to get rid of some people, right?
Well, I don't know that we need to get rid of some people.
No, I'm not saying we need to get rid of them, but they don't really. So instead of getting 10 offers, I get 4 or 5, and I just don't get the offers from the people who want, are putting 14% down and financing 86% of the loan. Because look, if you're financing 86% of a house, it's going to be very sensitive to interest rates.
That's true. And I think that the people that are going to end up on the sidelines are the people who require seller contributions. Sellers are about to be in a situation where they no longer have to do that in order to get their price for the house.
Somebody's put a link on the video we just did and said, why are you telling people now's a good time to buy? We literally said it's not a good time to buy. You should have bought either September to October to January or more than 2 years ago. Those were the two good times to buy. We're not saying now is a good time to buy. It's not a good time to buy, okay? It's a good time to sell if you're a seller because now you're in control again. You went from having to pay concessions to now you're going to get, we're going to see multiple offers, no inspections, and the whole thing. So people want the house, right?
It's very likely that that's going to happen, certainly in particular price points, in particular markets. But remember, real estate is hyper-local. So if you're not seeing this in your market, it's not that it's not occurring, or maybe it is not occurring, but every market is different. And we're going to put up a video shortly, and we'll kind of go just in Vegas. We'll look at some zip codes and just the variation in when those zip codes went from a buyer's market to a seller's market and by how much. And this is just in the last few weeks and months, because real estate is so hyper-local. We've done other videos before where we've showed you, even zip codes that, 4 or 5 zip codes that all touch each other, and the disparity in those zip codes, anywhere between negative appreciation all the way to 20+% appreciation over the same period of time.
It was year over year, I think.
Right. And so real estate is hyper-local. So if you're not experiencing this, please hang tight, because it just may not be exactly where you are. It may still be happening in your market, but not necessarily exactly in the pocket where you're located.
Here's the last thing about macroeconomics, because I get a lot of people, I think they probably have a good understanding of macroeconomics because they say the right things, but then they're not applied properly. So here's the thing they'll say, but Todd, credit card debt and credit usage is rising rapidly. Mm-hmm. Yes, that's true. It is rising rapidly. But whose credit card? It's not people who own buying investment properties with cash because they're financially responsible. It's not people who have 800 credit scores because they don't behave that way. The people whose credit card debt is rising rapidly are not purchasing homes. They're the part of the market. Remember, we gave the statistic that there's like 300 plus million people in the U.S. and there's only going to be 4 million home transacted. So a little over 1%. So you have a lot of people, they're not even in the market for a house. They're not buying a house. Who cares what happens with their credit card? It's not affecting the housing market. And you also know that 37 million people said they want to buy a house this year. Right. And they're not going to be able to. Certainly some of those are tenants, and some people have terrible credit. They're not going to. So the truth is the housing market is literally going to be decided by the 4 million people who decide to buy, who actually decide to buy. And everybody else, it's like you could just put a big X in them. It's not like the stock market where every transaction means something for the stock market. It doesn't in the real estate because you have a lot of people who are not going to be involved in the real estate transaction, in a real estate transaction 2023.
Right. Yeah, and regarding people and the rising credit card balances, so a couple things to keep in mind. First of all, they're not all homeowners. A lot of them are tenants. And then the second portion is this isn't really necessarily a problem so long as they're able to service their debt, right? I mean, that's really the bottom line. When you get into a problem is when people are treating their house like a piggy bank and they are getting home equity loans to pay off consumer debt. That becomes more problematic over time because if home values then decline, they no longer have equity in the house. So now if something else happens, they don't have that piggy bank to reach into. So that becomes more problematic. However, lenders have learned from the past, and home equity lines of credit are few and far between. They're harder to get, and they're not allowing as much debt to income ratio. They're not allowing as much equity to be drawn out of the home. So even with that, it's not the same scenario that we faced a dozen years ago. This is a different situation.
And here's the other thing about the different situation. Those people putting 14% down, they're not going to get their offers accepted in the next few months because it's going to be a competitive market and sellers are going to first go with cash then they're going to go with people putting 50% down, and then 40, and then 30, and then 20, and then 15, and then 14% down. They're not going to just be, oh, wow, you're putting 14% down. That's incredible. They're like, I just felt that when I read the article and I went and looked at this, I was like, this is painting the picture that like everybody's going to have to deal with this. And, we list homes, so we get to see the offers. And you'd be surprised how many people are offering cash or saying, well, we only want to put 40 or 50% down, but we could buy cash if we had to.
Right.
But they just want the option to finance a portion of it because maybe they're trying to buy 2 houses or like 2 investment properties instead of 1.
Right. Or, whatever the reason is, there are people who are in the financial position of paying cash for a property, but are choosing for their own reasons to not do so, whatever that is. And the current interest rates are not discouraging buyers from purchasing because we know that because transactions are happening and there are buyers looking at houses all the time. Open houses are really busy. We have a lot of people calling. We are seeing multiple offers again. So we know that buyers have become accustomed to the current interest rate environment because people are adaptable, right? And so the interest rate thing, I think, is old news, but it's certainly news that still drives clicks. And I think that's why you see headlines like the headline of this article.
I don't know what it's going to be yet. I'll make it after I make the thumbnail.
No, I meant the article that you're referencing.
Yeah, the article's headline was terrible because it's basically, I was immediately seeing the comments, forced to sell.
Okay.
Man, that guy who bought the house 2 years, he's forced to sell now because his mortgage payment just went up. And my rent payment only went up by 5%, right? Or whatever.
All right. So if you thought this was interesting, if you agree with us, if you disagree with us, if we entertained you, please like the video, please subscribe, hit the notification bell, share the video, leave us a love note, and be nice to everybody in the comments. Bye.
Bye.